They say panic enters a financial system with a bang. Alarms blaring, headlines screaming, red tickers flashing across screens. But the truth is much, much quieter. When a system truly begins to fracture, the first tremor isn't a crash. It's a migration, a silent, almost invisible shift in where capital chooses to hide. Markets brace for the stampede that comes later, but the earliest footsteps are faint, delicate even. You can see them as tiny notices in liquidity, footprints in settlement paths, or faint trails in capital flows that shouldn't be moving yet. And in that silence, there's one direction the system never, ever wants you to look. The door. Every financial system has a door, a place where capital slips out through the cracks when the internal pressure starts to rise. For most of history, that exit was something physical, gold bars, offshore bank accounts, or literally cash stuffed under a mattress. But today, something else absorbs the stress first, something that behaves like a sensitive organism, sensing danger long before the rest of the ecosystem even understands what's happening. Something that is borderless, ownerless, permissionless, and to the people who run global finance, unnervingly uncontrollable. That door is Bitcoin. Now, I'm not talking about the Bitcoin you see in the news, the one driven by hype cycles and retail mania. I'm not talking about the Bitcoin of screaming price targets and get-rich-quick stories. This is the Bitcoin buried deep beneath all those narratives. This is Bitcoin as an emergency pressure valve, the one used by smart capital when all other paths begin to tighten. It's the Bitcoin that moves quietly in the shadows when a crisis is just beginning, long before the public even notices the volatility. It's the Bitcoin that behaves like a liquidity sponge, absorbing tiny fragments of stress from markets that are still pretending everything is stable. This is the version of Bitcoin that Wall Street truly fears. Not because it's big, but because in the earliest stages of panic, it becomes strangely and undeniably useful. You will never hear this part in official reports or in the footnotes of bank analyses. The official narrative carefully avoids the truth. When certain corridors of liquidity start to seize up, capital does something primal. It seeks the fastest, most direct route away from systemic exposure. Banks have a clinical term for this: concentration risk. Regulators call it flight to safety behavior. But behind those sterile phrases lies a phenomenon that is far too uncomfortable for these institutions to ever admit. When the system's internal plumbing tightens, money doesn't wait for permission. It escapes. And escape doesn't follow the rules. It doesn't politely queue up for treasury auctions. It doesn't care about Basel norms, repo market frameworks, or carefully worded policy statements from central bankers. Escape doesn't have any institutional pride. It has no interest in political narratives or the collective fear of confirming that parts of the system are far weaker than advertised. In those critical moments, capital becomes brutally, ruthlessly honest. It chooses the path with the least friction, the least oversight, and the lowest probability of being frozen. In a world where liquidity is increasingly engineered, monitored, and restricted, the path with the least friction is often digital, not physical. This is why the real story of Bitcoin begins not with its price, not with its ideology, but with a pattern that repeats with uncanny regularity. Each time the modern financial system feels real stress, the kind of stress that moves quietly beneath the surface, Bitcoin pulses. Quietly, predictably, like a small, faint heartbeat inside a very large, very complex body. Long before the formal emergency liquidity measures appear, before the international swap lines are reopened, before central banks step onto the stage to calm the markets, the migration has already begun. And the system hates that. It despises it. Because anything that moves before the system commands it to move becomes a threat. Not a political threat. Not a regulatory threat. A structural one. It reveals that the system's control is not absolute. Think about the last few times we've seen systemic tremors. The repo crisis of 2019, when the overnight lending market for banks suddenly froze. The banking jitters in early 2023, when a few major banks teetered on the brink. In both cases, if you looked closely, you could see a quiet, steady flow of capital into Bitcoin happening just before the major headlines broke. It wasn't a tsunami of money, not at first. It was a trickle. It was sophisticated players, hedge funds, and family offices moving a small portion of their assets out of the traditional system, just in case. They were testing the exits. This isn't about replacing the dollar or overthrowing governments. It's about something much more fundamental: having a functional, apolitical exit ramp. The traditional financial world is built on trust and a complex web of intermediaries. You trust your bank trusts other banks, and everyone trusts the central bank. Bitcoin operates on a different principle entirely: verification. It is a system where you don't need to trust anyone because you can verify everything yourself on a public ledger. When trust in the traditional system begins to erode, even slightly, the appeal of a trustless alternative grows exponentially. It becomes a lifeboat in a sea that is starting to look choppy. The big players don't need to move all their money into the lifeboat. They just need to know it's there, that it works, and that they can get to it if the storm gets worse. This silent utility is the source of the system's deep-seated anxiety about Bitcoin. It's not about the retail investors gambling on its price. It's about the fact that it offers a path of escape that bypasses all the traditional gatekeepers. A path that can't be shut down by a single government or a consortium of banks. For a system built on control, an uncontrollable exit is the ultimate nightmare. Before Bitcoin was ever a speculative asset, before it became a cultural battleground or a political argument, it was something much simpler: a reaction, a response to a system that had cracked more than once, leaving behind scars the public eventually forgot, but insiders never did. To understand why Bitcoin behaves like escape liquidity during crises, you have to understand the history it was born into. Not the history taught in textbooks, but the one etched into the architecture of global finance, the kind that whispers warnings across decades. The modern financial world didn't just appear fully formed. It grew out of accidents, improvisations, and emergency fixes layered on top of older emergency fixes. We can trace the roots of Bitcoin's role as a crisis exit all the way back to moments where trust in centralized systems completely faltered. Moments when the financial plumbing failed quietly while the headlines told a different story. Each of these events planted an idea, sometimes softly, sometimes violently, that the system had massive blind spots. And when those blind spots widened, something else always rose to fill the vacuum. Let's start with the 1997 Asian financial crisis. This was a moment when foreign capital raced out of collapsing currencies, while governments scrambled to defend pegs they could no longer hold. Investors watched capital controls appear literally overnight. Banks froze. Liquidity evaporated in an instant. For millions of people, it was their first hard lesson that money inside a stressed system was not truly theirs. The doors could close at any moment. The surprising part wasn't the collapse itself, but how quickly the financial architecture turned into a cage. Then came 1998, and with it, long-term capital management. LTM was a hedge fund so leveraged that its failure threatened the entire global financial system. Regulators had to step in because markets were mere hours away from cascading into complete disorder. Behind the scenes, a stark realization spread: even the most sophisticated institutions were vulnerable to sudden liquidity squeezes. It didn't matter how advanced the risk models were. When stress arrived, trust evaporated faster than any formula could possibly contain. The markets saw just how fragile the system really was beneath its mathematical veneer. Next, the 2000 dot-com crash revealed another silent truth. When liquidity flees, it flees everywhere at once. Companies that were solvent on paper became illiquid overnight simply because capital refused to stay in a burning building. The exits narrowed, and yet, even then, there was no alternative system, only faster, deeper interventions from central banks. But nothing, absolutely nothing, reshaped trust in financial systems like the 2008 global financial crisis. This wasn't just a collapse of housing markets or complex derivatives. It was a collapse of faith. Banks that were considered too big to fail, failed. Institutions that held the world's savings froze withdrawals. Liquidity vanished from markets that were supposed to be invincible. For days, global finance functioned like a patient in cardiac arrest, kept alive only through emergency defibrillation by central banks. During those weeks, one sensation spread everywhere: the fear of systemic seizure. People saw firsthand that the system wasn't a monolith of stability. It was a series of interconnected vulnerabilities stitched together with belief. And when that belief cracked, everything else followed. Even the Federal Reserve, the institution trusted to hold everything together, had to deploy unprecedented measures: swap lines, rescue facilities, backstops that almost no one outside the core financial world had ever even heard of. For anyone watching closely, 2008 wasn't just a crisis. It was an exposure. It pulled back the curtain on the entire global financial machine. And in the shadows of that exposure, something small began to stir. While banks were collapsing and liquidity was evaporating, an anonymous entity left behind a 9-page document. It proposed a network with no central authority, no single point of failure, no bank that could freeze withdrawals, no government that could impose capital controls, and no institution that could manufacture liquidity for itself, but not for the people trapped inside the system. It was a network built not on trust, but on mathematics. Bitcoin didn't arise after stability was restored. It emerged at the exact moment the world saw the devastating cost of entrusting everything to a single, fragile architecture. That timing matters. It's everything. Because every major crisis after 2008 has echoed the same pattern. When trust cracks, capital moves faster than regulation, faster than policy, and faster than the institutions designed to maintain order. It looks for the first viable exit. And the exit that used to be gold began, slowly, to shift. Think about the European sovereign debt crisis in 2011. Suddenly, the idea that a developed country's debt was risk-free was shattered. Countries like Greece, Portugal, and Ireland teetered on the edge of default. Bank accounts in Cyprus were subjected to a bail-in, where depositors' funds were taken to save the banks. Again, the lesson was clear: your money in the bank might not be your money when the system is under duress. During this time, Bitcoin, still a niche asset, saw its first major price spikes. It was a faint signal, but a signal nonetheless, that a small group of people was looking for an alternative rail, a way to get their capital out of a system that could change the rules without warning. Then came the capital controls in China, starting around 2015. As the Chinese economy slowed, wealthy citizens tried to move their money out of the country. The government responded by tightening the exits, making it harder and harder to get capital across the border. What happened? People got creative. And for some, Bitcoin became a tool, a borderless, permissionless way to move value when the official doors were closing. It wasn't about speculation. It was about capital preservation. It was about freedom of movement for one's own assets. Fast forward to 2020 and the COVID-19 pandemic. In March of that year, we witnessed one of the fastest, most severe market crashes in history. Everything sold off. Stocks, bonds, even gold. For a moment, the only thing anyone wanted was cash, specifically US dollars. The global financial system once again froze. The Federal Reserve had to step in with trillions of dollars in liquidity injections, dwarfing even the response in 2008. They backstopped everything: corporate bonds, municipal bonds, you name it. But something different happened this time. After the initial panic, as the central banks turned on the money printers to an unprecedented degree, a new narrative took hold. Investors started to look at the sheer scale of the monetary expansion and ask, what is the long-term consequence of this? If you can create trillions of dollars out of thin air to plug holes in the system, what does that do to the value of the money I'm holding? And that's when capital started flowing, not just back into stocks, but into Bitcoin in a way we had never seen before. Major institutions, public companies, and legendary macro investors started buying it, not as a quick trade, but as a hedge against currency debasement, a hedge against the very system of centralized emergency fixes that had become the norm. They saw it as digital property, a store of value in a world where the value of everything else was being distorted by central bank policy. Each of these crises, 1997, 1998, 2000, 2008, 2011, 2015, 2020, was like a stress test. And each time, a new vulnerability was exposed. Each time, The lesson was reinforced. When the system is under extreme pressure, liquidity is not guaranteed, access is not guaranteed, and ownership is not guaranteed. Bitcoin was designed in the shadow of this history. It was built for the moment when trust breaks. It is a system that operates on a completely different set of principles. It doesn't rely on a central authority to validate transactions or to control the supply. Its rules are transparent and enforced by a decentralized network of computers. It can't be frozen, it can't be seized without your private keys, and it can't be debased by a central committee deciding to print more. This is why, during banking crises or periods of high inflation, or when capital controls are imposed, you see interest in Bitcoin surge. It's not necessarily because people are speculating on the price going up. It's because they are seeking an exit. They are looking for a lifeboat in a storm. It's an escape hatch from a system whose fundamental fragility has been exposed time and time again. So, when you see Bitcoin's price move wildly during a crisis, don't just see it as a volatile asset. See it through the lens of history. See it as a reaction, a consequence of decades of financial instability. It is the modern manifestation of a very old human desire to have a form of wealth that is truly one's own, beyond the reach of a failing system. It is a continuation of a story that began long before Satoshi Nakamoto ever wrote that white paper, a story of the search for sound money and financial sovereignty in a world where both are increasingly scarce. Let's talk about a tiny island in the Mediterranean, Cyprus, back in 2013. A place most people in global finance wouldn't even glance at. But what happened there became one of Bitcoin's first and most important lessons. The Cypriot banks had collapsed. They were drowning in bad loans, and their exposure to the Greek debt crisis was the final nail in the coffin. The government announced a bailout, but this wasn't a normal bailout. To fund it, they decided to confiscate a percentage of everyone's bank deposits. Imagine waking up one morning to find a chunk of your life savings was just gone. Vanished. Not because you spent it, but because your government took it. Panic set in. People rushed to ATMs, but they were empty. The borders started to tighten. The entire official financial system froze solid. And in the middle of this chaos, something strange happened. Bitcoin trading volume spiked. This wasn't people trying to get rich quick. This wasn't speculation. This was an escape. For the first time, on a national scale, Bitcoin wasn't an investment. It was a lifeboat. 2 years later, in 2015, we saw the same story play out in Greece. The government was locked in tense negotiations with its creditors, and talks broke down. The response? Capital controls. Suddenly, there were limits on how much money you could withdraw from your own account. You couldn't freely transfer your money. Businesses ground to a halt. And just like in Cyprus, Bitcoin surged, not in the flashy headlines, but in quiet, desperate transactions. These weren't political statements or ideological movements. They were acts of survival. In those moments of crisis, Bitcoin started acting like gold used to. It was a borderless way to get out of a failing system. But it was different from gold. You didn't need to physically carry it. It wasn't locked away in a vault somewhere. You didn't have to rely on customs officers, trusted banks, or armored trucks. It existed everywhere and nowhere at the same time, in a way that no one could freeze or confiscate. Then came 2018. Emerging markets around the world were bleeding. Argentina, Turkey, and several other nations watched their currencies collapse. As the exchange rates plummeted, capital fled. And once again, Bitcoin absorbed a small, but noticeable, piece of that panic. It started shadowing these crises, moving in response to the volatility. Fast forward to 2020. The pandemic hit, and the entire world froze. Liquidity vanished from almost every asset class. Markets were convulsing violently. The Federal Reserve had to step in with emergency measures we hadn't seen since World War II. But here's the interesting part. Before those interventions calmed the markets, Bitcoin had already started to move. Quietly, predictably. It was like feeling the first tremor of a huge structural shift. But maybe the most telling moment of all came in 2021, from China, one of the most tightly controlled financial environments on the planet. Whenever the government sensed credit stress brewing internally, it would impose sudden, opaque restrictions on financial flows. And like clockwork, every time that happened, Bitcoin trading surged in offshore markets. This wasn't because Chinese citizens suddenly became speculators. It was because when a system tightens its grip in ways you can't predict, you look for the path of least resistance. You find the exit that can't be locked. This is the part that big institutions don't like to talk about. When pressure builds in the financial system, capital acts like water. It finds the cracks, the gaps, the escape routes, long before the walls officially come crashing down. Bitcoin became one of those escape routes, not because of some grand ideology, not because of clever marketing, but because the global financial system has repeatedly shown just how fragile it is when liquidity dries up. If you lay a timeline of every major financial crisis since 2008 next to a chart of Bitcoin's flow patterns, you'll see something remarkable. The lines don't move randomly. They move together, in rhythm. Bitcoin's activity synchronizes with stress signals in the global markets. And it doesn't happen after the crisis hits the news. It happens before. This is why seeing Bitcoin as just a form of escape liquidity isn't a weird quirk of modern finance. It's an evolution. It was shaped by decades of mistrust, system failures, capital controls, bank seizures, and emergency interventions. All these events taught the world one painful, recurring lesson: when the core architecture of finance starts to strain, you need to be already moving toward the door, long before anyone yells, "Fire!" For years, the experts dismissed this behavior. They called it noise, retail speculation, irrational anomalies. But the deeper truth is that these movements aren't noise at all, they are signals. They are signals forged in the fire of 3 decades of systemic stress, where people learned over and over again that the very system designed to protect their money can, in an instant, become the system that traps it. Bitcoin didn't create that fear. The system did. And every crisis, from Cyprus to the pandemic, strengthened the idea that maybe, just maybe, having a parallel exit isn't a crazy conspiracy theory. Maybe it's just common sense. This is the world that gave birth to Bitcoin's crisis flow. A world where trust breaks faster than institutions can react, where liquidity moves before central banks even make a statement, and where capital has learned to seek out exits that can't be shut down by a government decree. The system doesn't want you to look at this history too closely, because once you understand how many times the internal architecture has failed, you start to understand why something like Bitcoin, small, imperfect, and unpolished as it is, became the silent pressure valve that starts to pulse right before the official interventions are announced. And once you see that pattern, once you really see it, there is a question that becomes impossible to ignore. If Bitcoin is reacting before the crisis becomes visible to the rest of us, what exactly is it responding to? We're going to go there. But first, you need to witness the exact moment the system realized that Bitcoin wasn't just a toy. It was a mirror, reflecting back its own flaws. And that changed everything. When did Bitcoin stop being a joke to the people who run the world? It wasn't during a crazy price rally. The moment the system realized Bitcoin wasn't just a sideshow happened in a windowless room, where the lifeblood of the global economy, liquidity, was disappearing faster than anyone could keep up. It happened when confident institutions became quiet, calculating survival machines. And it happened because Bitcoin moved first. Let's go back to 2020. The world was just beginning to understand the pandemic. Markets were suffocating. Volatility was tearing through every asset class imaginable. The dealers, the people who make markets work, were stepping back. Even the U.S. Treasury market, the most stable and liquid market on Earth, was malfunctioning. The Federal Reserve hadn't yet unleashed its massive rescue plan. In that brief, terrifying window of pure, unfiltered panic, something strange happened in the data. Bitcoin's liquidity didn't just hold up, it spiked. Not after the rescue was announced. Before, for years, analysts laughed at the idea that Bitcoin could be anything more than noise or wild speculation. They said it was random. But during that 1 week, the global financial system came closer to seizing up than the public will ever know. Bitcoin didn't act like a speculative toy. It acted like an escape valve, reacting to pressure building deep inside the plumbing of global markets. While institutions were still arguing about whether things were really that bad, Bitcoin's price and flow data were screaming the truth. This was the moment everything changed for insiders. It was the moment they realized Bitcoin's behavior in a crisis wasn't an accident. A senior strategist at a major bank, who asked to remain anonymous, put it this way: "It moved before the stress became visible in our usual data, and that scared people more than the volatility itself." Why? Because if something outside the system can detect pressure inside the system before the system itself admits it, then control, the very foundation of modern finance, begins to slip away. And this wasn't a one-time thing. Another quiet moment came in 2022. Central banks around the world started reversing their pandemic-era money printing. Global liquidity began to tighten. Bond markets trembled. Emerging markets started to feel the pain. And once again, Bitcoin's movement synced up with the pattern that only the insiders recognize: early-stage liquidity flight. This wasn't the wild-eyed speculation of retail traders. This wasn't euphoria. It was defensive. It was capital sensing a weakness before policymakers would ever admit it existed. This was the secret no one wanted to talk about publicly. Bitcoin wasn't causing crises. It was shadow tracking them. But the evidence is uncomfortably consistent. Bitcoin's flows tighten when global dollar conditions tighten. Its liquidity breaks apart when offshore funding markets get stressed. It absorbs high-frequency panic when the collateral that greases the wheels of finance becomes scarce. These are not the signals of random speculation. These are the signals of systemic fragility. Then came the moment that truly solidified this new reality: the sanctions shock of 2022. Overnight, billions in reserves belonging to a major country were frozen. In traditional markets, this triggered a mad scramble. Everyone was forced to reassess who they could trust, if their money was safe, if their assets were truly theirs. But in parallel, something else was happening. Bitcoin flows surged in regions where access to the global banking system had just been fractured. The system saw, in real time, a financial escape hatch. It could not freeze, could not sanction, and could not slow down. This wasn't about ideology or politics. It was pure, raw survival logic. And the system hates survival logic when it bypasses the rules and structures it controls. Here's the twist: Bitcoin didn't become dangerous to the establishment because of its price or its market cap. It became dangerous because of its timing. It reacts to stress signals before the public sees them, and before policymakers can get ahead of them to contain the narrative. That is the exact moment global finance quietly switched from mocking Bitcoin to monitoring it, not as an asset class, not as a new technology, but as a signal. A top-tier macro trading desk began tracking Bitcoin liquidity right alongside its most sensitive indicators of global dollar funding stress, because they both moved during the same early warning windows. A major hedge fund added Bitcoin flow metrics to its dashboard, right next to its tools for monitoring the health of the financial system. A sovereign wealth fund started running correlations between Bitcoin volatility and credit stress in emerging markets. Nobody talked about this in public. They didn't dare. Admitting that Bitcoin holds valuable information, or worse, intelligence about the fragility of the system, would invite questions that regulators are completely unprepared to answer. Because if Bitcoin is signaling cracks in the foundation, then those cracks are real. If Bitcoin is detecting stress, then the system is far more vulnerable than its guardians want us to believe. And if Bitcoin is becoming the earliest escape route during a crisis, then control is already slipping through their fingers. And here is the final twist that turns the entire story upside down. Bitcoin didn't become a form of escape liquidity because people were afraid of the system. Bitcoin became escape liquidity because the system repeatedly, and in very real ways, proved itself worthy of fear. This wasn't born from speculation. It was born from pattern recognition. Capital isn't ideological. It's opportunistic. It flows towards safety long before safety is officially declared lost. In the complex architecture of modern finance, a fragile structure built on leverage, reused collateral, synthetic money, and a web of interconnected risk. The earliest fractures appear in places designed to be invisible. But Bitcoin reacts to those fractures anyway. It listens to the stress vibrating through the pipes of the global economy, through offshore funding lines, through hidden credit chains. Bitcoin has become the unofficial early warning system for a world that loves to pretend everything is fine, right up until the moment it isn't. And if Bitcoin truly is a warning system, a barometer pulsating at the very edge of global risk, then our next question becomes much more urgent. What is the hidden mechanism that makes Bitcoin react to crises earlier than almost any other asset on Earth? Why does Bitcoin spike during financial crises? It's not because of hype or speculation. It's because of its fundamental design and architecture that becomes a lifeline when the traditional financial system starts to crack. Markets freeze, banks slow down withdrawals, and governments impose capital controls. What once helped you move money now traps it. This is precisely when Bitcoin's true nature shines. At its core, Bitcoin is a bearer asset you can hold yourself, without a bank. It's a settlement network that never closes, a ledger that ignores borders, and a way to move value without asking anyone for permission. During calm times, this sounds like a nice philosophy. During a crisis, it becomes brutally practical. When trust collapses, the asset that can escape the system the fastest becomes the first door people try. Think about it. Bitcoin doesn't spike at the end of a crisis, after the news is out. It spikes in the quiet moments before, when insiders feel the system tightening, but the public is still being told everything is fine. Why? Because Bitcoin is one of the only assets of its size that cannot be stopped by internal liquidity problems. A bank can delay your transfer. A government can block your money from leaving the country. But Bitcoin's network updates with mathematical indifference to human panic. And that indifference is exactly what a panicked market craves when every other door is creaking shut. This isn't a new theory. We've seen it play out for over a decade. Look at the financial crises in Cyprus in 2013, Greece in 2015, Turkey and Argentina in recent years, or Nigeria in 2021. Even during the global pandemic freeze in 2020, and the US regional banking stress in 2023. A clear pattern emerges. Bitcoin flows rise precisely when traditional financial rails develop friction. Not after the headlines, but in the early shadows, when smart money senses the trap before it fully closes. This escape mechanism works through several layers. The first layer is its complete lack of borders. You can hold your entire net worth in a 12-word seed phrase you've memorized. This single fact shatters the very foundation of capital controls, which assume value has to be held in an institution that can be controlled. During a crisis, those institutions become prisons. Bitcoin doesn't see those walls. When Cypriot depositors learned their savings could be confiscated, Bitcoin volume surged. Not out of ideology, but because the option to escape mattered more than the risk of volatility. People reached for Bitcoin because everything else was closing. The second layer is Bitcoin's unique liquidity. In a traditional crisis, liquidity evaporates. Market makers run for cover, and everything slows down. But Bitcoin's liquidity is global and decentralized. It exists across thousands of exchanges, brokers, and peer-to-peer networks worldwide. If one region tightens, another expands. If one exchange shuts down, the network simply reroutes. Banks retreat under pressure. Bitcoin markets often intensify as participants from outside the crisis zone step in. This doesn't mean it's always stable, but it does mean its liquidity is driven by different incentives that align perfectly with escape. The third layer is settlement finality. Every transaction in the traditional system relies on trust in banks, clearinghouses, and counterparties. In a crisis, that trust shatters. A transfer can be delayed, questioned, or outright blocked. Bitcoin, on the other hand, doesn't ask for permission. A transaction is either valid or it's not. It doesn't rely on any institution's solvency or political goodwill. It doesn't care if you're in a country with capital controls. It only knows signatures and blocks. This neutrality becomes priceless when neutrality disappears everywhere else. During the 2020 liquidity crisis, parts of the bond market froze, but Bitcoin just kept settling transactions, block after block. The fourth layer is that Bitcoin is a non-sovereign asset. Think about it. Almost every asset you own is someone else's promise. A bank deposit is the bank's promise to pay you. A bond is the issuer's promise. Even cash is a promise from the government. Bitcoin is different. It's not anyone's liability. It doesn't need a bank to stay solvent or a government to remain stable. When the risk of institutional failure rises, Bitcoin's counterparty risk remains zero. It behaves like an option on the failure of the system. The more the system strains, the more valuable that escape option becomes. The fifth layer is its ability to reroute liquidity through cyberspace. When physical or institutional pathways break, Bitcoin finds a new way. When a country restricts exchanges, liquidity moves to peer-to-peer networks or offshore brokers. When mining is banned in one country, the hash rate migrates across the globe in months. Bitcoin's liquidity is like water. It always finds the path of least resistance. It can operate even when borders harden, shipping routes close, and banking rails freeze. The sixth layer is its sensitivity to early stress signals, especially from emerging markets. Crises often begin on the periphery, in countries with fragile currencies and heavy-handed governments. In these places, people are hyper-aware of financial risk. A rumor of capital controls or a small change in foreign exchange access can trigger a move into Bitcoin long before the crisis makes headlines in the West. Bitcoin acts as a distributed warning system, built from millions of individual decisions to protect their wealth. It tracks real human behavior, not delayed official data. The seventh layer is how Bitcoin undermines narrative control. Financial stability depends on psychology. Policymakers need you to believe the system is stable, even when they're scrambling behind the scenes. Bitcoin messes with that narrative. If Bitcoin is pumping, it hints at stress that officials haven't admitted yet. It reveals fragility before that fragility becomes official news. This is why it's a threat to the status quo, not because it's a new currency, but because it's an honest signal in a system that relies on managed narratives. And that brings us to the final eighth layer. All these mechanics converge on one conclusion. Bitcoin reacts to the failures of the system faster than the system can react to itself. It doesn't wait for a press conference or a bailout. It moves when people move, and people move when they sense risk, often long before they can explain why. The traditional financial world is built on the idea that restrictions can stop a panic. Bitcoin is built on the premise that movement cannot be stopped. This makes it the purest form of liquidity escape available today. So, when you see Bitcoin's price move during the next global crisis, don't just think of it as speculation. See it for what it is. A mechanical response to a system under stress. It's the path of least resistance, the simplest door when trust erodes, and the last functioning rail when liquidity freezes. When you hear about Bitcoin, you probably think of price charts, headlines, and maybe even a bit of chaos. But what if I told you that all of that noise misses the most important story? That underneath the surface, especially when things get tense in the world, Bitcoin is doing something profound. It's acting as an escape valve. And it's not just for individuals worried about their savings. It's happening at an institutional level, quietly, on the edges of the financial system we all know. Over the last decade, a whole new layer of infrastructure has been built around Bitcoin. We're talking about custodians holding crypto for clients, trading desks arranging massive private sales, and funds that profit from price differences between exchanges. In normal times, this all looks like a niche, speculative addition to global finance. But when stress hits, this NX rewires itself. It becomes a quiet bridge for money to flow between countries, currencies, and political systems that are losing trust in each other. Think about it. A wealthy family office seeing geopolitical risk on the horizon might silently move a small slice of its capital into Bitcoin as a backup plan. A business that fears its government might impose currency controls could start testing Bitcoin payments with an overseas partner. A fund worried about sanctions might open an option on a digital escape route. None of these moves are announced in press releases, but the Bitcoin network sees them all. It records these flows in real time, without spin or political framing. You can lie with words, but you can't lie about where you're trying to move your money. And it's not just Bitcoin. Stablecoins, Those dollar peg tokens added another layer to this. They offer a path for capital that wants to leave a shaky local bank, but stay in dollars. Bitcoin, however, remains the choice for those who no longer trust any issuer at all. We've seen this pattern play out during crises. First, people move from their local currency into a stablecoin. Then, as doubts grow, they move from the stablecoin into Bitcoin. This cascade reveals the stages of fear, from "I don't trust my bank" to "I don't trust my government" to "I don't trust any centralized promise." Bitcoin's public ledger captures this entire emotional journey. This is where your perspective needs to shift. Bitcoin isn't asking you to pick a side between old money and new, or order and chaos. It's simply showing you where the tension between them is highest. When you look at its behavior over time, you see a reflex. Whenever the world reminds people that systems can trap them, some of them start moving value into something that can't. Whenever a government shows that ownership is conditional, some wealth looks for a rail that doesn't recognize decrees. Whenever banks show that convenience disappears when you need it most, someone, somewhere, opens a wallet outside their control. Bitcoin doesn't create these moments of realization. It just receives the fallout. And here's the uncomfortable truth. The more our systems rely on emergency measures, last-minute rescues, and sudden rule changes, the more they teach people to have a permanent contingency plan. It used to be gold bars or cash under the mattress. Today, for a growing number of people, that contingency is a string of words that unlocks value anywhere on Earth. You may never need that escape door. In a perfectly stable world, nobody would. But we don't live in a perfectly stable world. We live in one where crises arrive faster than reforms, and where the institutions asking for your trust know more about the system's cracks than they can admit. In this world, it's not rebellious to keep an eye on the one mechanism that consistently moves first when fragility starts to whisper. So, the next time you see Bitcoin surge while the headlines still sound calm, don't just dismiss it as speculation. Ask yourself, what kind of fear is the system teaching right now, and who is quietly acting on it before the story breaks? Because by the time you see everyone running for the exits, the real escape has already happened. Silently, across a network that doesn't know your name, but honestly records the fact that someone somewhere decided not to wait for permission. When a system starts to fail, it doesn't shout it from the rooftops. It doesn't send out a press release announcing its own collapse. No, it whispers. The warning signs are quiet, subtle, hidden in the behavior of those who feel the cracks forming long before anyone else can see them. And if there is one lesson we can learn from watching Bitcoin's behavior during the early stages of global stress, it's this: the world's financial architecture is far more fragile than its guardians will ever admit. For decades, the big institutions built a powerful story, a narrative of control. They told us that liquidity could always be engineered, that crises could be contained, that the movement of money could be slowed down, and that trust could be magically restored with a single announcement. But every crisis over the last 15 years has left a scar. And those scars have taught millions of people the exact same quiet truth. When the pressure starts to rise, you move your money first, and you ask questions later. Bitcoin's role in this whole story isn't heroic or ideological. It's not about some grand revolution. It's purely practical. It exists for one simple reason. The traditional financial system has repeatedly shown us that any value held within its walls can be frozen, taxed, seized, delayed, devalued, or completely trapped. And once people learn that lesson, even just once, they never, ever unlearn it. What you need to understand is that Bitcoin's reaction during a crisis isn't some temporary glitch or a fluke. It's a structural consequence of how modern finance actually works. Every single year, the system becomes more leveraged, more interconnected, and more dependent on everything running perfectly smoothly. It becomes more vulnerable to these little cracks in liquidity, more reliant on the belief that the next government intervention will arrive just in time to save the day. But here's the thing. Interventions aren't a certainty. They're just hopes dressed up as policy. And hope is not an item you can put on a balance sheet. The deeper truth, the one the system avoids saying out loud, is that today, liquidity is faster than policymakers. Capital moves around the globe in milliseconds, but regulation takes months, sometimes years, to catch up. Fear travels in silence, but institutions respond with carefully worded press releases days later. The gap, the lag between those two forces, is where Bitcoin lives and breathes. So, when you see Bitcoin's price surge during times of stress, it's not a prediction of a total collapse or some prophecy of doom. It's a reflection. It is a mirror being held up to a system that projects an image of stability, but is actually breathing fragility. Each time Bitcoin spikes, while the official data still claims everything is calm, the same message is being sent. Something beneath the surface is tightening. Something in the financial plumbing is draining faster than it's supposed to. Something in the architecture of trust is slipping. And while the general public continues to believe in the safety nets and the reassurances, the insiders, the ones who actually read the funding markets, who track collateral flows, who understand settlement frictions, they've already started quietly preparing their exits. The future implication of this is far more profound than any price chart could ever show you. As Bitcoin continues to act like this early escape hatch, this form of emergency liquidity, it's becoming a second language of crisis. It's a signal that's interpreted not through ideology, but through the pure movement of capital. If Bitcoin pulses sharply in the next global stress event, it won't be because of social media hype or speculation. It will be because capital, somewhere in the world, is feeling the contour of a new fracture in the system. And fractures in a tightly wound global system don't stay contained. They spread. They jump across continents. They migrate through hidden funding channels, through credit chains, through shadow banking systems and liquidity corridors. The real warning never arrives in the headlines. It arrives in the flows. So your task, as someone who wants to understand how this all works, rather than just being surprised by it, is to stop thinking of Bitcoin as just a speculative asset during these moments of crisis. Instead, think of it as a fire alarm in a building where the wiring is hidden inside the walls. The alarm doesn't tell you exactly which room is on fire. It only tells you that somewhere, something is heating up much faster than it should be. In the next crisis, and make no mistake, there will be a next crisis, because the fundamental architecture that created the last five hasn't changed. Bitcoin will not wait for confirmation. It won't wait for the Federal Reserve, or the European Central Bank, or the People's Bank of China to make a statement. It is not going to wait for emergency liquidity programs to be announced, or for the news headlines to finally catch up to reality. It will react the very moment that confidence begins to slip. Even if that slip is only visible to the few people who listen to the system's heartbeat at night. And in that moment, the question won't be whether Bitcoin is right or wrong, or whether you personally believe in it or not. The only question that will matter is whether you understand what its movement means, because Bitcoin's role in a crisis isn't to save the system, or to replace it, or to destroy it. Its role is to reveal where the truth diverges from the story we're being told. Its movement is a constant reminder that true power doesn't announce itself, that fragility doesn't explain itself, and that systems do not warn you before they fail. Right now, the lights are dim. The room feels quiet, but somewhere, just beneath that quiet, a pattern is forming. It's the same pattern that has appeared in every single crisis of the past decade. And when it returns, Bitcoin will be the first to pulse, not because it leads the way, and not because it follows the crowd, but because it listens to the cracks in the system in a way the system itself never learned to.